Howdy folks, welcome to yet another edition of our podcast, Smarter Money Matters, with the Wealth Doctor, Jeff Camarda, that's me, and our Super CIPs, Lou Vercel and Anna Wunderlich. Thank you so much for joining us. Today's topic is total wealth care, strategies for wealth creation and preservation that get results, or total wealth care explained, and some of the advanced techniques that the wealthy use to protect and grow their money. And when we talk about wealth care, total wealth care, some of the buzzwords that come up are wealth management, asset protection, avoiding financial mistakes, how to protect your wealth, estate planning and estate planning mistakes, wealth creation, and really fiduciary investment advisors. So we know we're going to be talking about what Camarda Wealth's definition of total wealth care is, but this is really not intended to be a pitch for you to become our clients, and many of you watching already are our clients. Of course, we talk about that if you want, but it's more, what you as a wealth holder, we think you should look for in terms of getting spot-on wealth management advice. And also for other advisors to learn from, and to augment their profiles, because we think it's really, really important information to help better serve your clients. So with that as background, I hate to put you on the spot, Anna, but tell me what does total wealth care mean to you?
I think, to me it means looking at our clients and their financial situation holistically, not just looking at investment management, which is common with a lot of wealth advisory firms, but looking at taxes, estate planning, risk management, all of these different factors that factor into their situation that can be extremely impactful if not handled correctly.
Very well said. And Lou, do you have, what would you like to add to that?
Yeah, very similar to what Anna just stated. It's just looking at all the different areas of someone's financial situation outside of their investments. Including their investments, but there's a lot of different areas that people care about and then we can help them in outside of just managing their money.
Yeah, well said. Now, I kind of call it like total wealth quarterbacking, to take the big picture, look at how all the pieces interact, because they most all affect each other. Portfolio management and taxes and asset location planning. Should I have that investment in my qualified tax-deferred IRA or 401k or in a taxable account as asset location planning? How do the taxes play into that? And they're different. Estate planning, how can I reduce my taxes because I own a business or I'm a real estate investor, and then that enables me to make more effective and cheaper Roth conversions to take tax-deferred money in a regular IRA and make it tax-free. There are so many moving pieces, and it's unfortunate, in our experience, that, in order to get to that level of mastery, you really got to study a lot. And Lou and Anna are both CFPs, which is a great program. I did it, I think, back in the 90s. But in my view, it's kind of the foundation. The CFP, which most advisors still don't even have, is the foundation for the beginning of really building advanced wealth knowledge in tax and a lot of other domains. But when you get it right and things really support each other, what's common is, I'm sure you have, typical investor, say, has got an investment manager or investment advisor, or maybe they have a broker, or maybe they have another investment advisor, and then they've got a life insurance agent that sold them some whole life insurance for reasons, and they have an attorney maybe that does their investment, or rather their estate planning, and then they have a tax advisor. And these guys kind of are all floated out in space, and you don't really know what their level of competence is or expertise. And do they talk to each other much? Do they coordinate? Do they understand what the others are doing? Do they trust each other, or they kind of view them as competitors and they become guarded? It looks like you got a couple of horror stories that you could share. I hate to put you on the spot, Anna, but do you find that's common, in your past, advisory life?
Yeah, definitely. even trying to get on the phone with a client's other expert, right? Get on the phone with their CPA or their lawyer, right? To make sure, we're all on the same page. It'd be increasingly difficult sometimes, and makes you wonder, right? Is that other professional looking to get more of the client's business because they're not willing to have that holistic conversation? Now, here at Camarda, when we can be on the same page with all of the client's experts, it makes it very easy to make sure that the planning that I'm doing with the client matches their tax profile, matches their estate planning, and then when we periodically check it out, make sure it's still sufficient. Clients can feel comfortable knowing that it's all holistically intertwined.
Good point. And a good example. I'm sorry.
No, I was just saying, a lot of those answers when they work, when we all have it under one roof, is just a phone call or email away, or you just kind of get up out of your office and walk down the hallway and talk to the tax professional. Give the call to the.
You mean here?
Here, yeah, absolutely, with us.
Yeah, so our total wealth care, which we'll get into a little bit. The way we visit it is, we do the planning on all areas: estate planning, tax reduction planning, asset protection planning, retirement income planning, investment management, and a lot of other things we'll talk about later on. So we have the big picture, and we have what we think is a really, really good eye for how things interconnect and can be optimized.
Sure.
But a lot of times, for instance, you find, LLCs, Florida LLCs, if they're properly constructed, are very strong asset protection vehicles. The ones that you come across, are they frequently not properly constructed?
Most of the time, if clients do it themselves, like you can go on Sunbiz and create an LLC yourself. Usually, those don't have the right operating agreements around them in order to make them protective to protect the asset.
Yeah.
They're just an LLC.
And even those that are formed by CPAs and attorneys a lot of times.
Sure.
Because asset protection, which is really, really important, that's protecting your assets from lawsuits and creditors. You get in a car wreck, with a football player or a wealthy, business person that makes a lot of money, an entrepreneur, and say they're out, their lost income is $5-10 million. Low probability, could happen, right? After whatever your insurance will pay, your liability insurance, and hopefully you have an umbrella, but after that, your assets, many of them are exposed. In Florida, your home is protected, your homestead, IRAs and 401ks are protected, some insurance products are protected, but joint accounts that are just in your name, bank accounts, they're on the table, they're right here. If I'm coming after you, that's really low-hanging fruit to pick up. And using a limited liability company properly constructed, which has got to be, what? Can you have one owner?
No, it has to be a multi-member.
Yeah, and it's also got to have the right, the language in the documents, the founding documents, the operating agreement, in order to comply with a Florida Supreme Court decision called Olmstead. But if you don't have those two things working for you, the LLC is worthless. And we see a lot of these that are set up, by attorneys and CPAs and others that probably haven't even studied asset protection. That's an arcane art, I got to tell you. In all my studies, my PhD, my master's in tax law from Georgetown, the CFP stuff, did you come across asset protection in a modern CFP curriculum?
Not really, no.
It's kind of off the radar, but so important. And there's a very small set of professionals that understand how to do it. But a lot of times the LLC, I got an LLC, but may or may not work. It might protect, a bottom-up attack for if you get sued, or if the company gets sued because a crane fell on somebody, that keeps it from going after your assets, a corporate bail. But if somebody sues you because you hit them with your pickup truck, and they get a $10 million judgment, everything you own that's exposed, top-down attack, is on the table. And the right LLC is very powerful medicine to protect against that, right?
Sure.
I don't mean to go off on a tangent on asset protection. We have, a lot of podcasts and YouTube videos and a lot of resources on Camarda.com, Camarda.com, if you want to take a look at that stuff. So in terms of putting it all together, and this is just our program that me and my team has developed and refined over decades, really. But the way we look at it is total wealth care really comes down to, first of all, quarterbacking. Having a team that understands all these different domains intimately: tax, estate planning, asset protection, retirement income funding, investment management, business and real estate investing, to put it all together, your unique fact pattern, to look at the big picture, come up with what we call a comprehensive wealth 360 plan. Something that these are all the opportunities you have. These are the things that are important to you. How do we best fit them together in order to target the best financial results for you? Then do quarterly wealth coaching, and we'll talk about that in a minute, where folks like Lou and Anna and their team are, in frequent touch with clients saying, let's talk about asset protection this quarter. It's time to update your estate plan, look at your beneficiaries, and have, a regular coaching schedule to make sure you get on track and you stay on track, because everything changes every day. That's just the way life is. And that includes custom portfolio management, using downside protection strategies if you're concerned about protecting wealth from a bear market. And those of you that are in or near retirement, really should be. I talked to a fellow yesterday, a just retired doctor, about $8 million liquid, and I'll call him Roger. And I said, Roger, you've done really well, but you got a pretty risky portfolio. Everything, the standard deviation, which is a risk measure, is well beyond the average of the S&P 500. Do you want to keep rolling the dice in retirement and maybe see a drop like we saw NASDAQ drop in the early 2000s and lose? Was 80%, I think, NASDAQ went down?
78, 80%.
That would kill you, right? At this point, why screw around with that? You got plenty of money. It makes sense probably to take some risk off the table or do some downside protection. Also looking at legacy stock positions. A lot of folks, and he's one of them, have stocks they've had for a while that have big gains in them, right? And if you go to some advisors that have the trading account, sell everything, recognize the gains. You got a big tax bill. You probably have seen that in your past lives, both of you. And do you need to do that? Maybe it makes sense to hang on to some of those positions and come up with a long-term plan to minimize the capital gains tax. Reviewing estate plans, look at the way your trust is constructed. Does it have protectors, and are the continuing trusts of the grandchildren? And these are both features that frequently trusts that our legal team examines that don't have a need. Have you found a way to avoid probate and guardianship? Have asset protection like we talked about earlier? Do you have investment real estate? And Lou, I know you have a lot of clients that have large investment real estate positions. And what are some of the challenges and opportunities that you've discovered with some of those guys and ladies?
Well, for one, making sure that their investment real estate is protected from lawsuits and creditors and so on. But also, trying to offer them different strategies in terms of potentially reducing their income if they qualify towards certain, what's called a real estate professional.
So using real estate basically because of the tax opportunities as a real estate investor, you've got the opportunity to really save a lot of money in income taxes if you're careful with your bookkeeping, you don't miss any tricks, and there's a lot of things that you can take advantage of if you think of them or have an advisor that, by the way, do you have, or you're optimizing your depreciation, are you expensing things you could expense instead of depreciating them, and you have the right fact pattern to make those currently deductible.
Sure.
But I think where you were going is that if you have, if you do it right, real estate can be a huge way to reduce income taxes.
Yeah, absolutely.
Right, which lets you do a lot of other stuff. Pay less on your W-2 income, maybe, or do Roth conversions, or recognize capital gains. You got that stock you paid $100,000 for, now it's worth $500,000. You got a $400,000 gain. If we can soften that with paper losses on real estate, maybe it's not so painful to get out of something you should get out of anyway, right?
True.
That kind of stuff. Mm-hmm. And also business consulting and liquidity event planning. So Anna, I'm going to let you talk about some of these items because I'm getting a little dry in the mouth here, if you don't mind.
No problem. Another thing that we do with the holistic planning is having a financial plan and updating it, right? So as clients move through life and they move through different life stages and changes, we're able to update that plan. And we do that through, helping them with retirement income and budgeting, right? If someone's leaving that accumulation phase when they're working and then they're shifting into retirement, helping them build out a budget so that they kind of know how much money they're going to need. We can even, run analyses on Roth conversions, Social Security, all these different planning items that, again, we can continue to revisit, whenever, annually with the clients. And then, something big that, gets swept under the rug by a lot of asset managers is liability, risk management, insurance, those types of things as well, which we cover at least annually with our clients, just making sure they have the right amount of coverage with life insurance, umbrella, those types of
You have the right
policies.
car insurance, you have the right, is your homeowner's policy, and we don't sell insurance, but we're strictly fee-only fiduciaries. We know a lot about it, but we're not looking to sell insurance, and you probably don't need, just to make a commission, to advise you on proper risk management, which is a really big difference.
Yeah.
But you have the right, say that, your house has gone, your homeowner's policy has a maximum of $300,000 and your house now worth $600,000. When I did my CFP studies back in the 90s, you reach a limit to where it's not going to go ahead unless you increase the coverage limits. You got a little bit of slop in there, but not double. And then the house burns down, you lost $600,000, you get a check for $300,000, you're unhappy. Stuff like that. And looking at all these moving parts for risk control, is important and complicated and really beyond the scope of what most folks get from their advisors.
Yeah, absolutely. I mean, that's one of the reasons that it's important to work with a fee-only advisor that's going to give you objective advice and not try to lead you down a path that may be benefiting to what their pocket at the end of the day. So
yeah, and so it's all about what's best for the client. That's the purity of the fee-only fiduciary approach. And there's two, and we'll talk about how to find screen for advisors that know what they're doing. You can trust in a later episode. But the two critical things in my view are they feeling you know what you pay, and the only source of income the advisor has is the fees that you pay them for advice. They're not trying to recommend this annuity or a life insurance product or this investment or a stock on a commission that benefits them as well if you transact, because then it taints the advice. And human beings are great at rationalization. Hey, I make 15% on an annuity and it's good for you too. What does that mean? You put $1 million in an annuity, if my commission is 15%, $150,000 of your money goes into my pocket next week, you're only left with $850. It could not be otherwise, right? The paperwork that the insurance company will give you will make it really, really hard to discern that. Like the account value, the surrender value, this value, that value. It kind of gets lost in the jumble. But the cruel math is, if you gave $1 million and he got 150, there's only $850 left. And that kind of stuff happens all the time. You don't have those conflicts and concerns with somebody that's a fee-only advisor. Fee-based, by the way, means, you know what it means?
It means they can take commissions. Fees are just the primary way they make money, but they can make it other ways.
Yeah, it's in the most visible way. Fee-based means fees plus commissions. That's honest. Fee-based sounds like something different, doesn't it? So it's, you pay me a small fee, and then you just don't see all the money that they're making on commissions. Your guard is down. So fee-only advisors, number one. Number two, that they've got the competence to know what they're doing. Just because you're fee-only, if you haven't got much training, you're probably going to drop a lot of balls because you haven't got the bandwidth to really look at the big picture and properly quarterback it. And I'd like to get back to something that you were talking about earlier, of smarter retirement income planning. Retirement planning really is more complicated than most folks think. The old Bengen rule, you take 4% of the principal, never run on many, so forth. But you have, the phases of retirement, right? Active, young retirees, and you have more sedentary, and then your health care costs increase, and then you have, final stage care for long-term care and that sort of thing. So you got to look at the different, expense stages you'll go through. Is there going to be enough money to pay for all that? And it's a pretty complicated calculation to figure out, the discounted cash flow analysis is coming in, this is what taxes are, you have this pension and so forth. Is there going to be enough? And what happens, I know that you guys are working on the Women in Wealth show that you were putting together. What happens when the husband dies first, which is the way to bet, right? Women lead longer, sicker lives.
Yeah.
Lower mortality, higher morbidity. But what's going to happen to your income? Are you going to lose the spouse Social Security? Is there a pension that goes away? These are important factors to make sure mama is safe and happy and secure. and also optimizing Social Security, which is kind of complicated. So there's a lot of moving parts here. And then, of course, there's looking at risk management, as Anna mentioned, life, disability, long-term care insurance. God forbid you have annuities, what's the best way to optimize those? And then also tax, estate, and legal. And the way we manage that, we offer those functions in-house, and perhaps some other advisors do. We have a legal team and a tax team, and clients can use ours. Or we're happy to work with them. As Lou was mentioned earlier, we're happy to work with a client's lawyer and tax advisor and so forth. And it's usually not optimal. In our experience, we found that, because people are people, and you don't want to offend them, and gee whiz, that shouldn't be on a Schedule C, or there's no protector of trust and so forth. And often people are very defensive of their work, professionals. So sometimes it's a little bit tougher road to hoe, but that's up to the client. We can do it either way. So we find we typically get better results if it's all one team, including tax and legal. So again, not to blow our own horn, I want to emphasize this is general wealth education for the public and for other advisors that would like to up their game. We're not looking for you guys to become Camarda clients. We're happy to discuss that if you want to, but that's not really the primary objective. But the way we do it here, and the only way I think you get stuff done predictably and maintain excellence, you can't rely on your memory, you have to have a system. We like to say that we use a Mayo Clinic type system that happens to be one here in Jacksonville, and those guys have great systems and things work, they're not forgotten. So our, continuous wealth coaching calendar is really subdivided into 4 quarterly buckets. Lou, you want to take us through quarters 1 and 2, and what your team is required to do for each client on a quarterly basis?
Yeah, absolutely. So in quarter number 1 of the first quarter of the year, we focus on tax planning and annual goal updates. And so we'll look at previous year tax returns that are going to be due at the end of that quarter. We'll look at clients' RMDs, required minimum distributions, for again folks that are up in the RMD age. We'll take a look at capital gains, any strategies that we could optimize in terms of writing off losses and stuff like that. We obviously we update their financial planning picture with looking at the different goals and what's changed in the course of the year from the last update, and then we'll also explore things like Roth conversions and any rental property business financial planning and so on in that first quarter.
So in Q2 or Q2. We focus on annual financial and retirement planning and goals, progress toward goals and updates. And to do this, we use pretty expensive professional financial planning software. There's a lot of financial planning packages out there. Some are pretty mundane. They're really glorified sales pitch programs, I think. Others require a tremendous amount of input, but are able to do some serious crunching to render, the comprehensive, rigorous plan that gives better insight into where you're going, where you want to go. Mm-hmm. And some of the things that you focus on, you help with budgeting, so forth, right? And what else?
Yeah, budgeting, like you said, stress testing their retirement income plan, and make sure that folks are not running out of money in their retirement. We look at different life events such as someone going through a divorce or any major topics that may be of interest. We'll also address Medicare and health insurance, and then optimize Social Security and consider things like I said, like I mentioned earlier, like Roth conversions and different tax planning strategies that may be relevant.
And also looking at opportunities for backdoor Roth IRA conversions, which can be a pretty slick trick if the fact pattern's right. But wait, there's more. That's only half the year. What do we do? When July 1st comes calling, Anna?
Yeah, so in the third quarter, we review, estate planning and beneficiaries, right? Making sure that things are set up for the client how they wish, making sure it's current with your wishes as things change, and that includes personal changes as well as tax law changes. Again, making sure that beneficiaries, account titling, everything matches how it needs to for your estate plan to operate properly. Review powers of attorney, living will, healthcare surrogacy forms, making sure they're up to date and still aligned with your wishes. verify that our clients are going to avoid expensive probate, which can be very expensive, address guardianship risks, right, and how to prevent a guardianship process if someone becomes incapacitated, review charitable giving, right, if a client wants to provide to charity, how is the best way to do so, maybe special needs family members, children, grandchildren, college planning, that type of gifting. Also talking about expected inheritances and estate management. And then lastly, if clients, kids, or other family members, are open to it, we like to involve them in the conversation as well, just so when, things happen, when those people need to step in, they're aware of what the planning is.
Which is really key. And I encourage all of you to involve your family and potential trustees and your kids and so forth, so they know what's coming, their input is going to be valuable, and also so they're not left, completely in the dark with a massive mess to solve. And then as the holidays approach, what happens in Q4, Anna?
Yeah, so the fourth quarter, we do our annual risk management, asset protection review, and tie up any loose ends for the year. Specifically, again, asset protection, risk control, any accounts that might be exposed if a creditor or a lawsuit was to happen, and then walk through steps on how to protect them. Look at liability, life, property insurance. Look at the policies like we talked about before. Is it enough coverage? Again, we don't sell insurance, but can suggest to a client to look into, additional coverage in certain scenarios. Look at year-end tax planning, whether that's capital gains, deductions, making sure we take required minimum distributions, and any of these other, financial to-dos that have a deadline of December 31st. And then lastly, start working on tax filing for the next year.
And then whatever last minute tax moves and optimize their position to minimize taxes for the year which is about to close. Most clients are calendar year taxpayers, and the bell rings December 31st, right? Mm-hmm. So thanks, guys. That was an awful lot to churn through, and I thank you all for your patience in going through that. But you can see, hopefully, that with total wealth care done comprehensively to our vision is a very complicated process, but it can yield results far, far more than a typical approach. Vanguard did a study a couple of years ago, even after paying for good advice, even after the cost of the advice, the net worth at the end was like more than twice as much. Anyway, thank you so much for suffering through, as the Car Talk guys used to say, yet another edition of Smarter Money Matters with the Wealth Dr. Jeff Camarda and Anna and Lou. Thank you so much for watching, and we'll promise to have yet another exciting episode for you next time. Thanks so much. Bye-bye.